Our next guest watching the markets, of course, and says stocks have priced in good news based on a Fed pause and expectations of a successful trade deal, but there could be some headwinds, as always. Joining us now to give us a market outlook is David Spica. He's Guidestone Capital Management President. David, thanks for coming in. So let's talk headwinds, shall we? What are they now? Because it seems like there's not a lot of concern being expressed in these markets.
No, there's not. The first quarter was very indicative of a quarter where risks were priced out of the market. And so our biggest concern today is earnings growth. And we're really paying attention to first quarter earnings reports. If you look at what the market expects right now, the expectations are for negative year-over-year earnings in the first and second quarter with margin compression, which we haven't seen in a long time. That concerns us, but that's generally what happens later in the cycle when the Fed's been raising interest rates, when stimulus starts to recede, and I don't think the market's focused on that. So that's the thing that we really want to focus on right now.
Well, why aren't they focused on that? We're watching retail investors actually pile in.
Because retail investors tend to buy high and sell low, right? I mean, they tend to jump on board when there's a lot of momentum. One of the things we're seeing today is FOMO, fear of missing out. And I think when the market's up, 25% off the bottom, investors are saying, I'm missing out on this. I need to get back in. And I'm not going to pay attention to the risk. I'm going to jump in because there's a lot of momentum. And I think that's what we're seeing today.
One of the things I was just at the turn of the hour, I was talking about my bullishness on the market. I tend to be a short-term focused person, but I'm watching the VIX Fear Index go down. I believe it's below a 12 handle recently. We haven't seen that number since Q3 of last year.
Right.
I've been getting some reports from traders who are fearful of another Volmageddon episode, not necessarily tomorrow, but maybe in 4 weeks, 6 weeks from now. I'm wondering if you see anything like that.
It's interesting that you cited the third quarter of last year. This feels a lot like the late summer, early fall of last year, when then we had this spike in the 10-year Treasury yield, and then we had that very difficult fourth quarter. Vol was very low at the time. Risk was completely priced out of the market. A little bit different situation. I don't expect to hit 325 on the 10-year, but with the 10-year around 2.5, 2.6, a 20 basis points pop here could create some concern by the market. But then again, it could also be an earnings issue. So we get a very poor earnings season. We get a lot of negative guidance. Investors might start pricing that in. All you need is the change in momentum, right? From up to down, and then you see a lot of these quantitative strategies and vol-type strategies just exiting the market, and you see a significant downturn.
So what do you do then? Do you sort of go long the market, but also have some hedging or more defensive strategies to cover your back?
Yeah, we would not advocate going to cash, although cash is pretty attractive today, given what we've been over the last several years. But we do think it's a good time to de-risk to a degree. So you can do that within your portfolio itself. So looking at less aggressive parts of the market. The cyclicals have led year to date. Tech's up 25%, industrials, materials. We think sectors like healthcare, which has gotten decimated, are very attractive today. Maybe a little bit of consumer staples. At the same time, you can look at other strategies. So defensive equity strategies today, strategies that are designed to capture most of the upside but limit the downside, make a lot of sense. So there's places you can do that. Bonds today. High-quality investment-grade bond portfolios we think are attractive as well.
Real quick, we had Mark Zandi on from Moody's, and my takeaway from that discussion was he was not perhaps as pessimistic as you might be.
Right.
And one of the things he cited, and we were talking about, is retail sales today. We got the number; it was up 1.5%. It seems to me like the market would still have at least another quarter, 2 quarters of growth in which investors may not want to be defensive just yet.
Okay. Good point. And can I shy away from the term pessimistic? I like the term cautious because we're not predicting a bear market or a recession. We just think stocks have gotten ahead of themselves and there needs to be an adjustment. But on that point, I think it's fair to say that the economy may be rebounding to a degree, but until we see that in earnings, we're not going to be comfortable with it. This 2,900 level in the S&P, the market's hitting a ceiling there because it's pricing in $182 in earnings next year and putting a 16 multiple on that. That's 2,900. Until those earnings estimates go up, and that's going to have to be a function of what we hear from management this quarter, it's tough for us to make sense out of the market going higher from here.
All right, David, thanks for coming in. David Spica of Guidestone Capital Management. Appreciate your time.